Are you advising clients to pile into equities at these prices?
I think, it's always a measured approach for clients. They have to be well balanced in their outlook for a long period of time. So it's a specific approach for each client.
The macro right now, one thing Diamond brought up in the conversation with our team in Davos is this disagreement between equities and the bond market. Who's right?
Well, I think, when you look at the equity market, there's been a lot of fear because we've been in a bull market for so long. And so there's been money sitting on the sidelines waiting for good opportunity, and that opportunity just has not happened for investors. And so there's a supply-demand issue in the market in that, there's fewer and fewer places to go in the equity market. There's fewer equities to invest in, and there is demand and people that want to get in. And so despite the fact that the market seems expensive, it doesn't necessarily mean it's overvalued. The two are not mutually exclusive. I mean, if you just take real estate in New York, I live in the Midwest, right? And so a property in the Midwest at $1 million might be overvalued. A property in New York, you might say, is undervalued. And so when you look at where equities are priced today, they look relatively expensive, but there's good reasons for equities to be expensive based on rates, based on lower cyclicality in the indexes and other reasons.
Andrew, you look at the returns that we saw in 2018, 2019, and you actually think that those were a pause year for equities years when you look at them, which surprises me because I think we had a pretty nice return at near 30% on the S&P last year. What does that mean then for this year and maybe 2021?
Yeah, it's fascinating. I don't think it's really that complicated. What is going on is the year after a drawdown, unfortunately, investors sell out of equities. They did in 2019 after 18. They did in 2016 after the drawdown of 15. They did in 2012 after the drawdown in 2011. But after a year of selling, what happened is people capitulate and they come back into the market realizing they made a mistake. The market went up in 2013 on fund flows going positive. The market went up in 2017 on fund flows going positive. I think your other guest nailed it, which is what's going on here is there's not enough selling power to push the market down on seemingly some of these geopolitical events we've had year to date. Look, the market looks overbought, but it's not going down. It's because there's not enough selling power. It's because people are capitulating and coming back in. So I think 2020, just like 2019 was a repeat, I think 2020 will be a repeat, which is bullishness will come back into the market and people will buy back into the market.
Well, we got the bull-bear spread now at, 2-year highs. I mean, to hear bullishness coming back into the market that would start to remind you of 99, right?
Sure,
there are some...
But the only issue that I would argue that, Carl, is sentiment measures are not what happens with people's money, right? People can say they're bullish, but have they invested, right? The number one purchase asset last year was the money market. To me, it's easy to say you're bullish, but let's look at how much money has come back in. It's only starting to happen.
No, there's a ton of examples where survey data, soft data, doesn't match hard data. So the argument here is that we're still positioned weekly. I mean, we're still positioned in terms of investor positioning for further equity strength?
Right, yes. And if you think about it, the market was fairly narrow. When you look at the spreads between value and growth, when you look at the spreads between large cap and small cap, there are still areas and pockets of the market that are still relatively attractive. The value index lagged dramatically versus growth. Small caps lag dramatically. Emerging markets lag dramatically. And so for active managers who are looking at those places to go, there are plenty of places still in the equity market that can gain ground.
And so those are the places you would go. You're looking for some catch up in some of those names.
Yes, and I think
some of these value names.
Yes, I still think there's shortages for growth, so I still think you will see growth opportunities and seeking yield opportunities. But along the way, you'll see value come along partly because we're going to see banks inflect, and that will help the value indexes, and just because of the lagging that you've seen over the last several years, where growth is just powered through.
Andrew, one last thing: we're a dozen days away from Iowa. The caucus is there. Do you think the bigger 2020 risk, let's say first half 2020, is A political story or a traditional bond spike that gives equities I don't know, 5 to 8% correction?
Right. I think high. Look, I don't buy the market's expensive given where interest rates are, but I am worried. But my number one worry this year is that the economy gets hot. You have a president who wants to get reelected. He knows the economy's strong. We'll get him elected. I think the economy gets hot. You get a spike up in interest rates, and then the PE argument becomes more of an issue. That does worry me. Too hot economy. Now, obviously, news with Boeing and so forth could push the first quarter GDP lower. But if we get a hotter economy later in the year, I think the PE argument gets challenged if rates get up into the 2.25 level.